Hello everyone, my name is Vinay Suneja. I'm a SEBI registered research analyst and the founder of Analytical Advisors. This video is part of the Getting Started with Option series, and today we're going to talk about what is an option. Standard disclaimer, anything that I talk in the video should not be considered as a financial advice. The video's purpose is mainly to help you have a better understanding of options. So in this video, we'll cover why you should learn about options, then what is an option, and then also looking at some of the examples of how to do option trading. So why you should be doing option trading, or at least have the understanding about it. So I'm assuming you already know that you buy a stock and then sell it at a later date. So you know how to buy and sell stocks. So now in option trading, why I should be doing and why I should be interested in this. So I'll tell you a few points. For example, first thing is regular income generation. So for example, how do you make money in selling stocks is you buy at a lower price and then sell it at a higher price at a later date. So, and unless you do that, you sell the stock, you don't make any money, right? You may make some money with dividends, but that are almost negligible for high growth companies. So here we can create regular income even when the stock is not doing much. I'll tell you in the various strategies later on, but for example, if I'm doing covered call or cash secured puts, I can still make money even if the stock is not going anywhere. Second thing is flexibility and strategy variety. So for example, when you are buying and selling stocks, you can only make money when the stock is going up and you sell it at a later date, right? If the stock is going down, you'll be losing money and you'll not be able to make any money. But if you're buying put options or selling calls, you can still make money, even if the stock is going down. Now, third thing is defined risk, right? Technically, if you are buying a stock, suppose Reliance stock at 1300 rupees, your 1300 rupees full is at stake, right? Whereas if you are just buying a call option, you only pay a percentage of that amount and you can have the benefit of the whole lot of Reliance, but technically you are only risking a very less amount, say like 10%. I'll tell you in detail how this works, but technically if you're doing this properly, you have a very defined risk here. Fourth option is lower capital requirement and margin efficiency. So like I said in the previous example, if you have to buy, for example, if you're buying the stock outright, you have to pay the full amount, whenever you buy the stock. Whereas if you're doing option buying, you only have to pay a certain amount, whereas you are still can have the gains of the total value of the stock. For example, if I buy one lot of Reliance, which is 500 shares, I have to pay about 6 lakh capital. Whereas if I'm buying just a call option, I can still make the profit of the full 500 shares, but I have to pay only say 20% of the value of the stock. So that's margin efficiency. So do you know any famous person who does option trading? Think about it. One example that I can give you is Warren Buffett. Yeah, guys, Warren Buffett, who is considered as a famous investor, but he also does option trading. And the famous strategy that he uses is covered calls. So what he does is he sells covered call option for the stock he owns. So while he's still making money with the stocks going up, he is still making passive income by selling covered calls. So that's the kind of person we want to be. Like, we can be an investor and a trader together by following safer option strategies. So what is an option? An option is an agreement to buy or sell an underlying asset at a specific price on or before a specific date. So let's take an example of buying a piece of land. So how do we usually do this? Once we finalize the location, the price, etc. of the land, we write an agreement with the seller. We pay a down payment, say 10-20% of the land value, and then we write saying that in the next 3 to 6 months we will pay the remaining amount and the ownership will be transferred to us. That agreement that we are writing is an option contract, you can think of. Here also we are agreeing that we want to buy a specific amount of shares on a specific date at a specific price. Now let's consider a scenario of buying Reliance shares outright versus via an options, right? So suppose I want to buy 500 shares of Reliance. So the current market price of Reliance is 1470. So the first option, how we are doing currently is we can buy shares outright. So we have to put 14, if we multiply 1470 by 500, which is about 7,35,000 rupees, we have to have this much amount in our demat account. And if we just click on buy, and it will buy the 500 shares, right? The second option is buying through a call option. So how do we buy through the call option? So I have to select a strike price, which is in this instance 1450, an expiry date of 25th November. And then for that, I have to pay a premium of about 50 rupees. So in total, and that is per share. So I have to pay 50 into 500, which is about 25,000 rupees. So I am paying about 25,000 rupees and entering into an agreement to buy Reliance shares by this date at this price. So this is called an option contract. Now think about it. What's the catch here, right? If I can get the ownership by just paying 25,000, I can, and so why will I even pay 7,35,000, right? So this is just an agreement to buy the shares at a later date, right? And the difference is also is here the premium in that we are paying in option is in addition to the 1450 that we will pay at a later date. So the main difference here, if you compare this to buying a land, is the down payment that you are doing is inclusive of the price that we agreed on, right? So 10% now and then 90% later, for instance. But here the premium that you are paying is in addition to the price that you have agreed on. So we have agreed on buying this as 1450 plus the 50 rupees that we are paying for the agreement. So the total cost when we are buying using this is 1500 for Reliance price, but at a later date, right? So this is comparing buying the shares outright versus buying shares through a call option. Okay, let's make sure we understand all the terminology we discussed in last couple of slides correctly. So expiration date, the expiration date is a date that the agreement is valid till. So that's the last day of the option agreement that we signed, right? The strike price is the price that we are ready to buy or sell the stock. So if we are doing an option buying, we have agreed to buy the stock at that price. If you are doing option selling, we are agreeing to sell the stock at that price. And we'll look at the buying and selling in the next slide. The premium you can compare it to that down payment that we made for paying for buying that land, right? That's the premium. Now, and the lot size is the amount of shares that we are buying. So usually the lot size is fixed. Like for example, in Reliance, it's 500. So you can't buy the shares, like for example, you can't buy one share through an option. You have to have the certain number of shares only in a lot, and then you can buy the number of lots. So like say if you want, you can buy Reliance in 500 multiples. So that's called a lot size. Okay, so let's discuss the different option types, right? So this, if you're new to option trading, I think this slide, you can take it as a screenshot and put it somewhere for reference later, but this is going to be very useful. So now if you're an option, in the option, you can either be a buyer or a seller. So you can be an option buyer or an option seller, right? So, and when you are doing an option buying, you can either do a call option buy or a put option buy. Same in selling, you can either be a call option seller or a put option seller. So there are always these four scenarios. Either you can buy or sell, and if you are buying, you have two options: call buy or put buy. Same way in selling, a call sell or a put sell. And you can have this screenshot so that you can remember this later on, right? So a key thing to remember is whenever you are an option seller, you always earn premium. You always keep that premium, right? And whenever you are an option buyer, you always pay that premium. If you think of that example back of buying the plot, if you are buying that plot, you are paying that premium, right? And if you're selling that plot, you are keeping that premium. So, and now in the land, you can only do, you can only assuming that the price will go up. That's why you are buying, right? Whereas in the shares, you can do both ways. So if you think that the price of Reliance is going to go down, you can buy a put option right now and then say that I agree to sell this at a later date, right? Another key consideration is whenever you're an option buyer, you have a right to buy, right? Or a right to sell. Whereas wherever you are an option seller, you are obligated to sell or obligated to buy. So there's a difference between right to buying and obligation, right? So key thing to remember here is option seller always keeps the premium regardless of the outcome, right? So you can take this as a screenshot. You may not understand everything right now, but you can take this as a screenshot and have it for reference later on. Okay, now let's compare what is better, option buying or option selling. I have compared option buying versus selling on 3 KPIs. One is percentage of profit, second percentage of loss, and third probability of profit. So when we are doing an option buying, we can say, for instance, we bought a call option of 5 rupees of Nifty on an expiry date. That technically that call option can go to 500 rupees also in a matter of minutes. And this has happened in the past, where a few rupees call option has gone to like 200, 300 rupees. So percentage of profit can be very huge. Then percentage of loss. Now what we are doing is we are only betting that 5 rupees, right? So now our loss is only limited to that 5 rupees. So for example, even if the Nifty goes to 0 tomorrow, my loss will be limited to that, the premium that I have paid for buying that option. Now, third thing is probability of profit. The probability of profit in this scenario is relatively less. Think about it, like how many times have you heard of the call option or put option going to like, multiplying 100 of times, right? So the probability of profit is less in this. Now, if you talk about option selling, now option selling, the maximum profit that you can make it is that premium amount, right? How much premium you got from the buyer that's your maximum profit. So that percentage is relatively less, right? Now percentage of loss. So percentage of loss is relatively higher because you own the stock or you are selling the option. So that means you have that land, right? So if the land price goes to 0, technically you will be in a huge loss even though you made that premium. Third thing is probability of profit. Now here is a key difference. In option selling, the probability of profit is higher. By default, the probability of profit is 66% if you are an option seller, whereas 33% if you are an option buyer. And the reason is you have to be for you to lose, the stock has to really go in the opposite direction and it has to really go fast. We'll look at in detail in the next videos about theta decay and all, but the probability you can understand is the probability when you are selling an option, the probability of profit will be very high. You can compare this scenario to becoming, either a casino owner or a poker player. So an option seller is technically a casino owner, whereas an option buyer is a poker player. So now, how many times have you seen a poker, a player winning big in a casino? It's relatively less, right? Like you win a lottery, but one person may still win the lottery, but many of them lose, right? Whereas casino, they make a small amount per customer, but they pretty much always win, right? So that is an option seller versus an option buyer. So what would you want to be, an option seller or an option buyer? Well, technically you don't have to choose one or the other. You can be both an option buyer and an option seller at times. And we will look at it in the, in the upcoming videos. So all in all, how do I make money, right? I now understand the basics of option. I know option buying, selling, etc. How do I still make money here, right? So I'll give you a couple of examples and then maybe this will help you see how much money you can make, right? And so let's talk about, let's take one scenario like buying call option, right? Which we looked at similar earlier also. So one scenario is I can buy the shares outright, right? Then I have to pay the Reliance share that I'm buying outright. I have to pay 7,35,000 rupees. And suppose the Reliance goes above 10%. So I will make like 10% of 7,35,000. That's about 73,000, right? So whereas if I'm just bought a call option and the Reliance price goes 10% above, technically I will be winning that same 73,000 rupees, but I have only put in 25,000 rupees for that, right? So now my gain is like more than 100%, right? So I have put in 25,000 rupees, the Reliance price goes 10% above, and now my 25,000 rupees will be more than like about 1 lakh rupees, right? Because I still make 73,000 rupees on that 25,000. So my percentage of winning is pretty higher, right? Now let's talk about the selling call option. So similar scenario, I have the Reliance is going at 1470. I have 500 shares. Now suppose in this scenario, the Reliance does not go anywhere. Like there are several times, a few days where the price does not go anywhere. Like it's still in the range, and sometimes it's like 1420. Next day it's 1430. It becomes in the range. So if I sell a call option of say 1450 strike price, I'm receiving 50 rupees per share for selling that call option. Now I made that 25,000 rupees. And if the expiry of the stock is even 1 rupee less than 1450, I still make that 25,000 rupees. So that is that income generation piece I was talking about. I can be an option seller and I can make income without doing anything. So all I have to do is just sell the call option in the starting of the month. And if the stock does not go anywhere, I make that 25,000 rupees. Whereas if you are buying the stock outright and selling the stock and making money, you would not be able to do this, right? You will not be able to sell you are not selling the call options and you will not be making that 25,000 rupees as a rental income you can think of. So for reference, I have put in the list of the stocks that you can do option trading in. So total there are 5 indexes where you can do option trading, which is this. And then there are 209 shares at the time of recording of this video where you can do option trading. So how NSE decides what stocks you can do option trading in? Basically, they want to make sure that the stock is big enough and there is less or no manipulation in the stock, so that they keep adding or removing shares in this list. So you can go and check the list here. But right now there are 209 stocks, and mostly the bigger companies are all in here, right? So before you start doing these option trades, a very important thing is to understand the risks, right? So you can see the option trading is not as straightforward, and if you don't understand it properly, you have a very chance of losing in options. So be extremely careful how you want to do this, and it's better to learn before you do anything. So that's the make sure you understand the risk before doing any trading. All right, so the next steps on this is I will be making further videos on the option strategies like covered call, cash secured put, etc. So you can keep following our channel, and we'll see you in the next video.